The recent threat by President Donald Trump to halt imports of Chinese cooking oil in retaliation for China's soybean ban is a case study in asymmetric economic conflict. A data-driven examination reveals that this policy, which is framed as a countermeasure, is in fact likely to inflict greater costs on the United States than it is on China. And this highlights a strategic vulnerability on the US's trade war posture. The disparity begins with the sheer scale of the trades in question. China's suspension of US soybean purchases actually impacts an export market historically valued at over $12 billion annually. This action directly targets a concentrated and politically vital constituency, an estimated 400,000 to 500,000 US soybean farmers who form part of Trump's core base. In contrast, Trump's retaliatory threat targets US imports of Chinese used cooking oil, a waste product for biofuel, which peaked at $1.2 billion in 2024. The US is therefore responding to a $12 billion loss with a $1 billion threat, a mathematically disproportionate reaction that fails to address the core economic damage. The asymmetry deepens when assessing the impact on each nation's economy. For China, the loss of the US UCO market is manageable. Global demand for biofuel feedstocks is robust, and Chinese exports of UCO to Europe and Southeast Asia can easily absorb the diversion. In fact, China's UCO exports to the US had already fallen by over 40% in 2025, which demonstrates pre-existing market adaptation. The $1.2 billion in UCO exports is a marginal figure within China's vast trade portfolio, even to the US. For the United States, on the other hand, the consequences are more acute and multifaceted. The US biofuel industry has become reliant on inexpensive Chinese UCO as a primary feedstock. Suddenly cutting off this supply would increase production costs for American biodiesel and sustained aviation fuel manufacturers, potentially leading to higher domestic fuel prices and supply chain disruptions. This action would protect the interests of one group, soybean farmers, at the expense of another, the biofuel industry and American consumers, creating a net economic loss within the US economy itself. The gutter oil threat is not a demonstration of strength, but a signal of strategic limitations. The United States, by pursuing a retaliatory path that inflicts greater costs on its own biofuel sector and offers only a fraction of the relief required by its farmers, is poised to lose more in this exchange. It is a move that prioritizes political theater over economic reality, to the net detriment of America's own economy.